Welcome back to the deep dive. We spend so much time analyzing the intangible economy software, interest rates, all that I think we sometimes forget about the physical world.
We forget that the economy is still about moving atoms, not just bytes.
Exactly. It's about, at its core, moving physical stuff from point A to point B.
And honestly, the atoms usually tell a more honest story about what's really going on.
That is precisely why we're doing something a bit different today. We're not looking at a tech giant. We're not looking at a bank.
We're looking at paint.
We're looking at paint. Specifically, we're unpacking the Q4 2025 earnings from PPG Industries.
Which, I know, it might sound a little dry.
Pun intended.
Absolutely intended. But paint is arguably one of the best economic parameters we have.
Why is that? Is it just, like, how many houses are being built?
It's so much broader.
Oh.
Think about it. Almost nothing gets manufactured without being coated. If you aren't painting cars, you aren't building them.
We're fixing them.
Or fixing them. If you aren't coating aluminum cans, people aren't buying soda. One of the CEOs in this space used to say his business was all about tracking hunks of metal moving around the world.
So by looking at PPG's numbers, which they released January 27th, we're basically taking the blood pressure of the global industrial economy.
And the patient seems conflicted. That's the perfect word for it.
Conflicted how?
This report is a masterclass in contradictions. It's a classic beat and miss. On the one hand, PPG had a great quarter. They brought in $3.91 billion in revenue, which beat expectations.
Okay, so they sold a lot of paint.
More than they have all year. Their best organic growth of 2025.
But the stock dropped.
Because they missed the profit number. They missed earnings per share by 6 cents. And in this market, you can be off by a nickel and a penny on the bottom line, and Wall Street just punishes you.
So that's the puzzle we're going to solve. How does a company sell more paint, generate a ton of cash, but still fail to hit its profit target? We're going to look at a sold-out aerospace sector, a weird inventory issue in auto body shops,
and believe it or not, how AI is changing the chemistry of color.
It's a lot to unpack.
It tells a fascinating story.
Okay, let's start with the financials, this beat versus miss thing. Revenue was $3.91 billion, up 5% year over year. What was behind that? Was it just inflation?
See, that's what you'd normally think, but no. This was high-quality growth. Organic sales were up 3%, their best of the year, and it was driven by both volume and price.
Wait, so they sold more actual gallons of paint, and they charged more for them?
Precisely. And that's the holy grail, right? Usually you have to trade one for the other. They grew volume in every single one of their regions globally.
That's a strong signal of real demand.
A very strong signal.
Okay, so the top line is great. They're moving the hunks of metal. So why the miss on the bottom line? $1.51 per share versus the $1.57 target. Where did the profit leak out?
It wasn't one big thing. It was a collision of three sort of messy factors. The first one, and this is a great lesson in corporate finance, was medical costs.
Medical costs, like health insurance for their employees.
Yeah, PPG is self-insured.
Okay, walk me through that. Why do that instead of just paying, a big insurance carrier?
It's a bet on scale. If you pay a carrier, you're paying your profit margin. If you self-insure, you just pay the actual bills. For a huge company, it's usually cheaper in the long run.
But you're exposed to spikes, to volatility.
Exactly. And that's what bit them. In Q4, especially December, they saw a massive, unexpected spike in medical claims.
Any specific reason?
It was likely a combo of, a rough flu season and that end-of-year rush. People have met their deductible.
Ah, so they squeeze in that knee surgery before the calendar resets in January.
You got it.
Yeah.
And PPG got the bill for all of it at once.
Okay, so that's factor one. What was number two?
This one's kind of ironic. It was incentive compensation.
Bonuses.
Employee bonus.
Hold on. They missed their earnings targets,
Right.
so they had to pay more in bonuses.
That sounds backward.
It does sound backward. But remember that huge revenue beat and the great cash flow?
Right. Internal targets for the sales and operations teams are based on those metrics, not just the final EPS number. So the teams crushed their goals, and in Q4, accounting had to suddenly catch up and book the expense for all those bonuses.
So because they did too well selling paint, it lowered their profit.
It's what they call a high-class problem, but it still hits the bottom line.
And the third factor.
Just the boring stuff. Interest and taxes. Some old cheap debt came due, and they had to replace it at today's higher rates. And their tax rate ticked up a bit.
So if you strip out the sick employees and the bonuses for a job well done, the core business sounds healthy.
Better than healthy. I mean, if you want the real story, you look at cash flow. Cash doesn't lie.
And what did that look like?
It was a monster. $1.9 billion in operating cash flow for the year. That's up $500 million from the year before.
That is a huge jump.
It is. It shows the machine just printing money. They used it to return $1.4 billion to shareholders. So despite the headline miss, this company is a cash gusher.
Okay, so the engine's running hot. Let's look under the hood. One part of this business is, it's just screaming right now, aerospace.
Oh, aerospace is the star performer, no question. We're talking double-digit growth in 2025. They're guiding for high single digits again in 2026.
And I saw this phrase in their notes that just jumped out at me. Sold out.
Yeah.
In software, you can't really be sold out. But in the physical world, that's a very real problem. What does it mean for them?
It means they are completely capacity constrained. If a big airline called them tomorrow and said, I need an extra 10,000 gallons of sealant, PPG would have to say, sorry, get in line. Their order backlog is over $300 million.
Wow. Is this just about building new planes?
It's both. The OEMs, the plane makers, are trying to ramp up, but existing planes are also flying more hours than ever. More hours means more maintenance, and PPG sells to both sides.
And I think it's worth clarifying what we mean by aerospace paint. It's not just the white on the fuselage, is it?
No, and that's the key. That's low-margin stuff. PPG dominates the really high-tech materials. We're talking sealants, adhesives, and something they call transparencies.
Transparencies, like for an overhead projector.
A little more advanced than that. We're talking about cockpit windows, canopies, specifically for fighter jets like the F-35 and the F-16.
So, high-tech glass.
Not even glass.
Yeah.
It's advanced acrylics and polycarbonates layered together. Think what an F-35 canopy has to go through. Supersonic speeds, bird strikes, extreme temperatures. It has to be optically perfect.
You can't just whip that up in a garage. That sounds like a massive competitive moat.
A huge one. The certification process takes years. And that's why they're investing so heavily. They're putting $380 million into a new factory.
But a factory takes time to build.
2 years at least. So that doesn't help them until 2027, maybe 2028.
So what are they doing right now with customers demanding more product?
They're debottlenecking. They're spending about $120 million right now just to squeeze every last drop of production out of their existing plants.
So aerospace is the golden child.
It is.
But every family seems to have a problem child. And in this report, it's automotive refinish.
It is. And that hurts because historically, auto refinish is their cash cow. It's a great high-margin business.
And refinish is just a fancy word for body shops, right? Fixing crashed cars.
Correct. And sales there were down high single digits. It was a big drag on the company's margins.
Okay, connect the dots for me. People are still driving. People are still getting in accidents. Why are body shops buying less paint?
It's all about a change in behavior driven by your car insurance bill.
I try not to think about my car insurance bill. It's gone up so much.
Exactly. It's up, what, 20, 30%?
Yeah.
So when that happens, drivers change what they do. You get a minor fender bender, you back into a pole. A few years ago, you just file a claim.
Right.
But today, you look at your $1,000 deductible, you worry your rates will go up another $500. What do?
You just live with the scratch.
You live with the scratch. So claims for minor collisions were down double digits for most of the year. Fewer claims means fewer cars going into body shops.
Which means less paint being sold. But there was another layer to it, this destocking thing.
Yes, and that created this whiplash effect.
How does that work?
So imagine you're a distributor. You sit between PPG and the thousands of body shops. In early 2025, you bought a ton of paint thinking it was a normal year.
Okay, so your warehouse is full.
It's full. Then the insurance rates spike, and the body shops suddenly stop ordering from you. So when your PPG sales rep calls in October, you say, no thanks, I'm still trying to sell the stuff I bought back in June.
So PPG gets hit twice. Demand from the consumer goes down, and then the middlemen just stop ordering completely.
That's destocking. It's brutal. But they think it's finally over.
They're seeing green shoots, I think was the term they used.
Exactly. In December, claims are only down 2%, which is a huge improvement. And more importantly, those distributors started placing small fill-in orders.
Fill-in orders.
Like, hey, I'm completely out of this one shade of red. It's a signal that the big pile of inventory is gone. The shelves are getting bare.
Okay, so a slow start to 2026, but then a recovery.
That's the forecast. A muted first half, then back to growth.
Which brings us to the tech angle here. It feels weird to talk about artificial intelligence when we're talking about paint.
It does, until you realize that color matching is just a giant data problem.
How so?
Every car has a slightly different shade, right? It fades in the sun, batches from the factory are different. Your biggest cost at a body shop is your technician's time. If they mix a batch of paint and it's not a perfect match.
They have to throw it out and start over. Wasted time, wasted materials.
Exactly.
So where does AI come into that?
Well, PPG digitized their entire library of color formulas years ago. They have petabytes of data. And they're using AI to optimize those formulas. They just launched the first ever AI-formulated clear coat.
So the computer came up with the recipe?
It optimized it. It figured out how to get better durability using, say, cheaper or more sustainable ingredients. But for the body shop, the real tool is something called mix and shake.
Mix and shake.
It uses digital scanners and AI to tell the tech exactly how to mix the paint to match that specific faded fender on that specific 5-year-old car. It gets it right the first time.
That seems like a massive productivity gain.
It is. But for PPG, the strategy behind it is stickiness.
Sickiness.
If a body shop trains all its people on your software and they buy your special scanners that only work with your paint, are they really going to switch to a competitor to save a few cents a gallon?
No way. The switching costs are way too high.
It turns paint from a simple commodity into a whole technology platform. It locks that customer in.
Very smart. Let's zoom out a bit. PPG is global. Where are the geographic bright spots?
Mexico is on fire. Absolutely on fire.
Really? What's driving that?
A mix of strong retail sales and a big recovery in project spending. Volumes were up mid-single digits. It's all part of that nearshoring trend. More factories being built there need more coatings.
What about Europe? It feels like we've been hearing about Europe's industrial problems for years.
And it's still, quote, challenged. They were very clear. It's a maintenance market. They're not building a lot of new stuff. They're just painting the old stuff to keep it from falling apart.
Sounds pretty slow.
Volumes are flat. But here's the stat that just blew my mind.
Go on.
PPG has raised prices in Europe for 39 consecutive quarters.
39, that's almost 10 straight years of price hikes.
In a market with zero volume growth. That shows incredible pricing power. It proves their product is essential. You can put off painting that bridge for a year, but eventually you have to do it.
Okay, what about China? The headlines are all doom and gloom about their economy.
And this is where a deep dive really helps. Contrary to the headlines, PPG actually grew in China in Q4.
How? If the property market is a mess, who's buying paint?
It's all about electric vehicles. KPG is deeply, deeply embedded in China's EV supply chain.
Not just the paint on the outside of the car.
No. We're talking coatings for battery components, all the high-tech stuff inside. So as China exports millions of EVs, PPG is riding that wave, even if domestic building is slow.
So they found the growth engine within a slowing economy.
Precisely. And one other winner was packaging coatings.
Soda cans again?
Soda cans, food cans, double-digit growth. And this one is driven by regulations.
How so?
The world is moving away from chemicals like BPA and can linings. Regulators are demanding safer coatings. PPG invested in that tech years ago, so now as all the big food companies have to switch over, PPG is winning all that new business.
So let's bring it all together for 2026. What's the forecast look like?
Management is calling it a tale of two halves.
Which means the first half is going to be rough.
It's going to be slow. Flat to low, single-digit growth.
Right.
They're still working through that auto refinish destocking issue. But the second half of the year, that's when they expect to hit the accelerator.
Why the big jump then?
A few things come together. That auto inventory problem should be totally gone. Some of the new aerospace capacity starts to help. And they've got another $50 million in cost savings kicking in from restructuring in Europe.
What about their own costs? Is raw material inflation going to be a problem?
Surprisingly, no. They expect raw materials to be flat for the year. Some things are up, some are down. It all balances out. So margins should get better.
Okay, so if I try to sum up the investment thesis here, you have a company that is just a fundamental cash machine.
Almost $2 billion in operating cash.
It's got a rocket ship called Aerospace that's sold out for years. It has a temporary flat tire in the auto body business that looks like it's being reinflated.
Right.
And it has this incredible defensive moat in Europe with amazing pricing power.
That's the whole story in a nutshell. It's a defensive, cash-generating business with a high-tech growth kicker. You own it for the stability while you wait for the rest of the world to catch up.
And speaking of cycles, I want to leave our listeners with one last thought. You said Europe is a maintenance market.
Right. Just keeping things from rusting.
Well, big infrastructure projects, bridges, factories, they typically need a new coat of paint every 5 to 6 years. And Europe has been in this slump now for about 5 years.
Huh. I see where you're going with this. We're at the end of that deferral window.
Exactly. You can only put off painting a bridge for so long before it becomes a real problem. So if the economy there just stabilizes, not even booms, but just stabilizes, are we sitting on this massive pent-up wave of deferred maintenance?
The fresh coat wave. It's a very real possibility. At the end of the day, physics always wins. Rust doesn't sleep. And if that dam breaks, PPG is perfectly positioned.
Something to keep an eye on. The paint might be drying, but the business is anything but boring. Thanks for listening to The Deep Dive.
We'll catch you on the next one.